Hey, welcome back to Mr. Market. We are now into episode 11. Thank you so much for joining me. For the past week, we had a pretty strong week. The market rebounded strongly, up 1.97% after being down 2.67% last week. And like I mentioned last week, some of our best weeks tend to happen after our worst weeks. And so, mean reversion is a thing. So the market was pretty happy that a Federal Reserve member said that he was expecting interest rates to go up only 0.25%. And this was after the market was expecting a worse outcome. They were starting to expect maybe interest rates would go up 0.5%. So in the stock market world, when things are not as bad as expected, that's enough for a reason to rally. And so that's what we got. We had a pretty good week too, but mostly because we crushed it on earnings plays. We usually primarily just trade the S&P 500 ETF, but this week presented us with some really compelling opportunities, and I wasn't about to just leave all that money on the table, so we took it. For earnings plays, we did a total of 10 trades. Yeah, I know, that's a lot. And we made money on all 10 trades. We had a really good week, like I said. We traded Costco, Salesforce, Target, and even Tesla. And so for the week, we were up $2,335, putting our year-to-date gain up to $15,810. As a reminder, we're aiming to make $50,000 a year off a starting portfolio of $250,000. So our goal is to make 20% and 20% a year until we get to $1 million. That's the whole goal of this whole series. And we're 31% of the way there for the year, and we still have a little under 10 months to go, so we're well on track to reach that target. Okay, so let's talk about this past week's trades and how I approach individual company stocks during earnings season and how I trade them. So the basic idea is that we want to be able to identify the pre-existing trend and trade in that direction. It's as simple as that. Why? Because during earnings season, typically the earnings surprises tend to happen in the pre-existing direction of the trend. So it's really important to know how to draw a trend line, how to pay attention to the factors that are causing the trend to rise. And when we sell these options contracts, when we sell put options and when we sell call options, the value of these options the day after earnings tends to collapse on a massive level, typically about like 90% on the day after earnings if you play it right. And so that's what we did, and we played it right. But I need to emphasize a really important thing, and that is that there's going to be a time when you do everything right and everything looks right, but you will still lose. I mean, that's just the nature of probability in games of chance. That's why it's really important for you to size your bets properly, so that when you do lose eventually, your losses won't be so large that it'll permanently impair your ability to play another hand. You could be playing blackjack and have a 20, but the dealer can pull out a 21 and you'll still lose. Okay, so let's talk about our trades. First, let me give you an example for a really good stock. Facebook last year had a really big drop, and if you took a look at the pre-existing trend, it was negative before earnings. And so when we had that big drop, it happened in the same direction of the pre-existing trend. The next one, we had a big upside earnings surprise, and if you take a look at the pre-existing trend there, that was also positive. So that's kind of the basic thesis, is that we want to be looking at the pre-existing trend for earnings and play in the direction of that trend. All right, let's look at Target. What kind of trend do we have here? We have none. It's just been trading sideways. So what did I do? I ended up selling some calls up at 195 and some puts at 140, and those expired worthless. I guess you could say we were right on target. Haha. Next up, we have Costco. Now, if you take a look at this trend, it has been overall in a gradual decline, and I love the company, but I hate the valuations. And I figured even if it met expectations, the market wasn't going to be happy with it given how expensive it was. So I sold some calls at 520 And then the day after earnings came out, I sold some more at 485 when I had a pretty good idea that the market wouldn't be able to bring it back up to its previous closing price. And that expired worthless. So thank you, Costco. Another reason to love you. Next up, we have Salesforce. This is a really interesting chart because it was in a pretty defined downtrend and recently broke out above it. And the pendulum algorithm had become pretty positive on it as well. I like the fundamentals, I like the valuations. And so before earnings, I was initially thinking of selling some puts and calls, but because of the trend being positive, I only sold puts. So I had a strike price at 140. And then after the earnings came out, I sold some calls. I sold some calls up at 205, and I sold some more puts at 175, and those ended up making a nice profit as well. So I was being very cautious because of the trend being positive, and I didn't want to sell calls until after I knew where the stock had been ready to go. Okay, last stock, Tesla. If you take a look at this one, it has been in a pretty defined downtrend for a while, but also recently broke its short-term downtrend to be in an uptrend. So I played this one by selling some calls up at 240 and sold some puts at 175. And then after the investor day had disappointed investors, I sold some more calls at 210, and those ended up all making me some money. So overall, that contributed to a pretty positive week. Okay, so for the coming week, we've got Jerome Powell talking to Congress on Tuesday and Wednesday. And on Friday, we have the jobs number. And it looks like the economists are expecting about 225,000 jobs to be created. Now remember, January, we created over 500,000 jobs. And that was so far above what was expected that it derailed the rally that we had going on in early 2023. So this is going to be one of those Newton's external factors that's going to be shaping the market for the following month. In the short term, the market's gotten a little bit overbought, so I'm playing it a little bit more cautiously. I sold some calls at the $420 strike price, and I also sold some puts at the $390 and $385 levels. With Powell coming up and with the jobs report coming up, there's a good chance that we'll get whipsawed. So I may just take it easy and not adjust my positions later this week because I can get so many head fakes. So I may just take it easy, but we'll see how it goes. On Thursday, the pendulum algorithm turned bullish, and that was perfectly timed right ahead of that rally on Friday. And as long as it stays bullish, I'll continue to keep that bias. So that's it for this week. Good luck to you and me for the coming week. I hope we trade well. And if you haven't yet, please click like and subscribe, and I will see you next week.